Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research at the University of Buckingham. This is the regular update on monetary policy. I must admit at the start that on this occasion I'm going to be repeating myself. The kind of thing I'm going to be saying this month is very much what I've been saying over the last year. In particular, I had a presentation last December which is on very much the same theme, and that theme is: can monetary policy ever be exhausted? Can central banks run out of ammo? Can there be a situation in which there's nothing they can do to stimulate the economy? Now, I'm repeating myself, but I should say in mitigation that this subject is not only very controversial at the moment, but it's also basic to understanding of money and monetary policy, and absolutely vital to the assessment of the prospect for the world economy in the next few quarters. If it really were true that central banks could do nothing about a recession, then we would be in very deep water. I'm going to be referring in particular to an article in the Financial Times at the end of August by Lord Turner, who was chairman of the Financial Services Authority in the UK a few years ago. In that article, Adair Turner made this allegation again that central banks have run out of ammo and there's nothing more they could do. To quote him, "Because interest rates are close to zero, further cuts in such interest rates are bound to be small, and they make little difference to the economic outlook." So, Lord Turner says, central bankers are no longer that important, and the amount of commentary about what they do in financial markets is disconnected from reality. Now, I had a letter in the Financial Times protesting about what Lord Turner had said there, and on this occasion looking to be expanding the themes that I made in that letter. It should be said that Lord Turner is very far from alone in making these claims, and I should also mention an article recently in The Guardian by Larry Summers, economic advisor to President Obama, in which he said that interest rates can't be reduced any further, so central bankers really can't do anything very much in terms of helping the economy in this environment of stagnation, as he calls it. So what is needed, to quote him, is admissions of impotence, part of central bankers, in order to spur efforts by government to promote demand by fiscal policies and other means. In other words, there should be more government spending to boost the economy, and monetary policy and central banking are beside the point. Now, there are many other people who've made these sort of comments in the last few months, the last year or two indeed, and I want to deal with them in the next few minutes. Now, the nub of what I'm going to say is really just 2 points. One is that central banking is not just about setting interest rates. Central banks can take decisions that affect the quantity of money directly. And those effects on the quantity of money can be far more important than what they do to interest rates. And then secondly, and this is controversial, but I'm going to show you the evidence, and I've done so many times in the past, if there is an increase of, say, X% in the quantity of money, then there will be, in the next few quarters, a positive effect on the growth of nominal demand and spending and income, and in the end, national income will rise, not exactly by X%, but by some figure not far from X%. So in other words, central bankers have it in their power profoundly to influence the course of national income over the next few years, and that is why central banking matters above all. Now, I'm going to let me focus first of all on the first of these points. In a way, it should not necessarily say these things, because we're now over a decade since we had quantitative easing. Quantitative easing was an example of these processes at work in terms of action by the central bank to boost the quantity of money. But let me just go through this again. The central bank, even at zero interest rates or negative interest rates, can go to the banks and say, look, commercial banks, here's some more cash. Add that to your cash reserves, but then you add to us a balance. The central banks have an extra balance, and then the central banks spend that balance on anything at all from the non-bank private sector. We in the non-bank private sector hold bank deposits, which is our money, and money rises directly because of those actions by the central bank. A little bit complicated, but not that complicated. There's no doubt central banks can do these things if they want to. Sure enough, the government can do the same thing. The government can go to the banks, say, lend us some money. Money goes into government's balance in the first instance. The government spends the money and increases the deposits held by the non-bank private sector. The ability of the state to create money in this way is unlimited. In fact, it's such a power, it's so powerful, because of course, if governments overdo this, then they can add not just 5 or 10% the quantity of money in a year, they can add 50% or 75% in a month, in a week, and then they cause hyperinflations. And so in some nations, there are prohibitions in the constitution against government borrowing from the central bank, or even from the commercial banks. And these powers, the restriction on these powers is because they're so powerful, because they're so dangerous. In effect, what Lord Turner, Larry Summers and so on are saying by claiming monetary policy, central banks impotent, is that they can't cause hyperinflation. Well, they jolly well can. And that's proved, I'm afraid, in far too many cases, even at the moment, for example, in Venezuela. So, by far the simplest asset, by the way, in all of this, is for the government to buy back its own long-dated debt. There are some people who say that to have a powerful effect on the economy, what the central bank should do is buy, say, equities. No, the important point is the effect of these operations on the size of the quantity of money, because there's a relationship between the quantity of money on one hand and nominal GDP on the other. It isn't because it's more daring to buy equities, you buy equities. No. That's not the point. The point is to increase the quantity of money. Okay. And the simplest way to do it, rather uncontroversial way, is actually to buy back long-dated debt held by the non-bank private sector. There's no effect, by the way, on the size of the debt, and there's no effect on the size of the budget deficit. Now, how does this boost the quantity of money work? Again, you come across economists who think that the quantity of money can jump by 10%, 20%, 30%, does nothing to the economy. It's rubbish. The effect of an increase in the quantity of money is partly that, for example, companies may be short of cash. So they're having to hold back on expansion plans. They're having to reduce their stocks of finished goods, their inventories of raw materials and so on. And this is deflationary as far as the economy is concerned. When the quantity of money increases, some of that will go to companies. That then eases the strains on company liquidity. But there are also effects on asset prices. And this is where we get into Lord Turner's mountain of commentary, because of course the impact of extra money on asset prices is very much something that concerns participants in financial markets. In the textbooks, there's too much focus on the effect of the quantity of money on the price of bonds and then on bond yields that are a kind of rate of interest. Much more important in reality is the effect of extra money on the prices of equities and real estate, not fixed income assets, but variable income assets where the profits, the dividends, the rents rise with national income over time. And in practice, this effect of extra money on asset prices is absolutely fundamental to understanding how QE and these kind of expansionary operations work in practice. I found in my career that, roughly speaking, sometimes money and nominal GDP grow together, but quite often money rises a little bit faster than nominal GDP because people are becoming wealthier over time. They have a higher ratio of financial assets and housing, for example, to their total income, and then this requires them to have somewhat faster growth of money than their incomes. Let's just look then at the evidence. I've done this many times before. Let's do it again. We look at the UK. I've split up the period since 1964, when modern monetary data began, into 8-year periods, more or less 8-year periods. And you can see here that there's a relationship between the growth of money and the growth of nominal GDP. In the last 8-year period, we have the lowest increase in money of any of these periods of 8 years. We have the lowest increase in nominal GDP and the lowest inflation. Let's look at these numbers a little bit more. You'll see in the middle, those periods of 8 years I've marked in red, you had money rising faster than nominal GDP. That reflected financial liberalisation and Thatcher government, asset prices rising strongly, and also people holding more wealth relative to their incomes. Then look at the whole 55-year period. You had a 9.7% a year growth of money and about 8% growth of incomes. In America, going back slightly different period, you had 1960 to today, to 2017, you had 7.4% growth of money and 6.8% growth of normal GDP. But again, when you have slow growth of money, you have slow growth of normal GDP, and fast growth of money, fast growth of normal GDP. The mistake that Turner and Summers are making is to think that the only effect of central bank action is to affect interest rates and bond yields. No, far more important as far as assets are concerned is the effect of extra money on the prices of equities and real estate. Because financial markets knew that, that's why so many analysts paid attention to this subject. That's why there was this mountain of commentary that Adair Turner has been so dismissive about in his article in the Financial Times. So what about fiscal policy? As I've just said, Summers in his piece in The Guardian says that fiscal policy should be used because monetary policy can't be taken any further. I do wish these Keynesians would pay some attention to the facts, and that's what I'm going to do now in the next few minutes to finish off this presentation. I'm going to focus on the UK because that's the country we're talking about. I'm going to go back to the early 1980s. These are numbers covering the period from 1982 to 2018. And I show you in this diagram the rate of growth of real domestic demand and the rate of change in the fiscal budget balance. Normally it's taken for granted that an increase in the budget deficit will boost demand, and the IMF has very kindly produced some data going back to the early 1980s where we can actually check this hypothesis. The picture doesn't look that bad. It's pretty bad, but not awful. But there's a problem. But what the Keynesians are saying is that when there's an increase in the deficit, a negative balance, there's a boost to demand. So what we should really have here is two axes. We should have an axis on the left-hand side with positive values, down the right-hand side of the diagram, an axis with negative values. That's not what we've got. We've just got positive values on the left-hand axis in drawing this diagram. There's a period you can notice in the mid-1990s when the budget balance was improving. If I put it, budget balance was becoming more positive, and there was above trend growth of demand. This is completely contrary to the Keynesian argument. The Keynesian argument is you increase the deficit to boost demand. Here we see a period when the deficit is actually being reduced, moved towards balance, and actually we've got above trend growth of the economy. Frankly, fiscal policy doesn't work. We had, in Britain, 1981 budget, we had a period of fiscal contraction in the mid-90s, which was actually, again, above trend growth of demand. A period since 2010, when the budget deficit has been reduced, above trend growth of demand. Fiscal policy doesn't work in the way that the Keynesian textbooks say. Let's then look at monetary policy. What I've done in this diagram is to compare the rate of change of real broad money with the rate of change again of domestic demand, and again taking it back over the same period, back to the early 1980s. It's a prettier picture. I have to say it's far from beauty. There are all sorts of wobbles, all sorts of things that these two lines ought to go together if I were 100% right, but they don't. There are some difficulties with the data, and I concede that. But it's also true that the two big recessions in this period from 1982 to today, two big recessions in the early 1990s and in 2008, 2009, and we see that money captures both episodes very nicely. And let's then be very rigorous. Let's take an equation using these two types of policy, the change in the budget deficit, the change in real broad money. Let's look at them, see how they affect demand over this period using standard statistical techniques. The equation isn't that good, I have to say, but what I do want to point out is that fiscal policy just doesn't work at all in the way that the Keynesians say. As I say, the truth is that when you get fiscal contraction, there's an expansionary effect on the economy, there's expansionary fiscal contraction, stimulatory fiscal austerity indeed, and it just simply isn't true, contrary to what Lord Turner, Larry Summers and others believe, that if governments increase their spending and widen their deficits, that they boost the economy. On the other hand, monetary policy does work. The coefficient's got the right value. It's a very technical, the t-statistic on the coefficient is significant. It does work, even with lots of ifs and buts and problems. So my conclusions are that monetary policy can never be exhausted. And really that all of this stuff is so misguided. All this commentary about the weaknesses and failures of monetary policy is so misguided. The real problem for all of economists today is that their thinking about fiscal policy is in turmoil. They're just all wrong what they're taught and what they say. I do wish that Lord Turner, Larry Summers and many others of their ilk would pay attention to the evidence, and then they might be a little bit more sensible in what they recommend for policy. Thank you.